Today, I'll share a 15-minute chart strategy that picks tops and bottoms or market trends with precision. I've actually been teaching this strategy for more than a decade, and it uses one of my favorite indicators, which are Bollinger Bands. Bollinger Bands are simple to understand and even easier to use. By keeping things clean and easy, you'll be more focused on finding those high-quality trades, and I seriously hope this strategy will help you select the best ones. Before we dive in, make sure to hit that subscribe button and turn on the notifications bell so you don't miss our trading tips or strategies. Now, let's get started. First, let's talk about why the 15-minute chart is excellent for day traders who are looking for a slightly bigger move. The 1-minute and 5-minute time frame can be very noisy, and while these time frames are great for short-term scalps, and look for a future video on that one, picking tops and bottoms is also popular because it has a great risk-reward ratio. Unless, of course, you get fooled into buying or selling a pause instead of a turn in the market. If you are a new trader, though, or even an experienced one, I have to take this time to tell you that it is always more profitable and always less stressful to trade with the trends rather than against it. With that said, picking tops and bottoms is tempting, and so I want to give you a good way to do it. The most important advice I can give you for trading reversals is look for confirmation. Doesn't matter what time frame you choose. You never want to arbitrarily pick a top and bottom just because it feels like it's overbought or oversold. You want evidence. You need evidence. You need confirmation that the momentum is waning, that the buyers are losing their appetite, or the sellers are easing their flows. Only once you see that evidence, confirmation that a turn is happening, should you take a trade. Because as the famous economist John Maynard Keynes once said, the market can remain irrational longer than you can remain solvent, and usually it's rising and falling for good reason. Now the question is, what type of confirmation should you be looking for? That's where the Bollinger Bands come in. If you're not familiar with Bollinger Bands, they were developed by John Bollinger in the 1980s, and I actually had the opportunity to meet him in Asia. They are typically used by traders to understand price and volatility. Now, the Bollinger Band indicator consists of 3 lines: the middle line, which is a simple moving average, and the upper and lower bands, which are set standard deviation above and below the middle line. By default, the setting is typically 20-period simple moving average in the middle, or the 20 SMA, and 2 standard deviations from that are the upper and lower lines. When the bands are close together, that usually tells the trader that the volatility is low and maybe a breakout is coming. If the bands are wide apart, that means the trend is strong. But that is not the way we'll be using Bollinger Bands to pick tops and bottoms. We're going to be utilizing the standard deviation component of the Bollinger Band. And instead of just using the 2 standard deviation Bollinger Bands, we'll be adding the 3 standard deviation Bollinger Band. I call this strategy the extreme fade. So let's go to the charts and see how it works. Okay, so let's start with a clean chart. The first thing to do is add in Bollinger Bands. So you type in Boll and then you get Bollinger Bands, and by default you get the 20-period 2 standard deviations. Now what I like to do is I like to change everything the same color, because as I said earlier, when things are clean and they're easy to look at and they're easy to use, it makes it faster for you to make interpretations in real market environments. Just easier because it's not polluted by the rainbow of colors that you just saw there. So when you add Bollinger Bands to your charts, this is what you get as a default. The middle line is the 20-period SMA. The outside lines are the 2 standard deviation Bollinger Bands. Actually, I'm going to make the middle line, which is called the basis, red, just so you can see it easier later. So we have the outside lines, which are 2 standard deviations away from the moving average. The textbook way of using Bollinger Bands is that if it touches the 2 standard deviation, it's overbought, you should sell. If it touches the 2 standard deviation at the bottom, it is oversold, you should buy. Sometimes it works like here, sometimes it doesn't. With currencies in particular, especially when you have a strong trend, I bet we see that in dollar yen, that it can remain near the line, hugging it for right here's a good example, for very long periods of time. And so if you tried to pick the bottom during this phase here, you would have been faced with a lot of fake outs. So how can you look for confirmation? How can you trade the real turn instead of the fake outs? That's where adding the second set of Bollinger Bands comes into play. So I'm going to add in another set of Bollinger Bands, and you can see second set of Bollinger Bands here. This time I'm going to remove the basis. We don't need it. We're keeping the basis from the original one. Once again, changing it all the same color so that for interpretation purposes, it's easy. And then I'm going to remove the background. So we're gonna hit OK. Oh, I forgot one very, very important thing. We're changing the standard deviation from 2 to 3 standard deviations. And that's where we get our outside lines and our inside lines. Now, the outside lines are the third SDBB, third standard deviation Bollinger Bands. They're out here. The inside, and let me just add this onto the bottom over here. The inside lines are what we call the second standard deviation Bollinger Band. Second standard deviation Bollinger Band. And then we have that down here as well. Okay. So the whole idea and the rules for the trade goes as follows. If the currency pair, and first thing we want to do is see the currency pair close at or above the third standard deviation Bollinger Band, or on the downside, close at or below the third standard deviation Bollinger Band. Think about what that we're looking for when that happens. We're looking for the move to move 3 standard deviations away from the 20-period average. So you're thinking about like a rubber band where you get stretched to 3 standard deviations away from the average, and you want it to snap back. But it doesn't always snap back right away, right? Because you can see from the textbook way that I showed you earlier, sometimes these moves can last for very long periods of time. So the first step is to look for it to close above the outside lines, the third standard deviation Bollinger Band. You can see it doesn't happen at all in this period here, which kind of saves you from trying to pick this a top in Eurodollar in this period. Instead, when we do see it happen is over here. So here is where we see it close below the third standard deviation Bollinger Band. So that's rule number 1. Wait for it to close below the third standard deviation Bollinger Band. But when that happens, it's not time to trade. We need to look for confirmation. Just because it's blown out, doesn't mean it's time to arbitrarily pick a bottom, because maybe it's really big news and it might move further. So instead, what you want to do is you want to wait for it to close on a downside back above the second standard deviation Bollinger Band, the inside line. And it basically, let me flip this arrow over here, does it right over here. That's when you go long. Here we go long at 109.5960. Your stop should be 20 pips below the swing low. So in this case, 109.20. This is an emergency stop, okay? So as it continues to move in your favor, then you want to trail your stop up. It's just your initial emergency stop in case you're wrong. So where should you take profit? Typically with these trades, in my experience, they go about 20 pips. That's pretty easily achievable. Now the second way to exit is when it touches the basis, the 20 SMA, which is a technically significant level, or when it touches the Bollinger Band on the other side. So in this case, you go long at 109.60, and you're looking to exit at 109.80. And this one definitely, and it does, actually 109.80 basically, is coincides with this zone with the basis as well. Yes, that's not great risk reward, but once again, it's an emergency stop. If it kind of goes below this level, you want to reconsider the trade. And as it moves in your favor, you're quickly trailing the stop, so that if it goes to 109.70, you should be looking at your stop to moving your stop up to -10, for example. Here's another example. Now, this is not a great example because this is during the Asia session before the big US retail sales day. And typically, you want to avoid trading ahead of data. It's really wonderful to trade after data, which is what happens here. And those are the little things that you want to qualify your trade with to make it higher accuracy. Don't trade ahead of big news releases. That should be one of your cardinal rules for any setup, regardless of what it is. But this one would have gone long at 110.07 and, maybe exit it would touch the middle line or the Bollinger Band the other side. None of it would have been consequential. The better trade, or a nicer looking trade, is actually this one, where we do actually close this candle. We close above the third standard deviation Bollinger Band. You go short over here. So you go short at 120.27. The stop is at this high here, 110.42 plus 20 is 62. Goes a little against you, 5 pips, not much, no big deal. Then it comes back down. Now you entered a 110.28, so you obviously can't close it here. Let's go for plus 20. That's 08. And does it get there over here? No, it takes its time and eventually gets there over here. So you exit the rest of the trade over here. So that's another winner. But you also win when you don't take these false signals and then get trapped into picking tops in the Eurodollar, because at no point in time do we close below the first standard deviation Bollinger Band. So saving you from bad trades is the same as making money, in my opinion. Let's look at the pound dollar. So the pound dollar, this is the most recent chart, and there are no setups over here. This setup is the same trade as the Eurodollar, where it broke down after the US retail sales report that was much stronger than expected. You waited for it to close above the first standard deviation Bollinger Band, exit over here because this nice chunky pippage here. In pound dollar, I think it's like 30 pips, 28 pips. So at least 20 pips here, maybe you could trail your stop going. When it comes to profits, I'll let you figure out how to manage that yourself. And then there's no trades here. Here's a trade. We close below the third standard deviation Bollinger Band. You go long here, go long at 128.35. It never retraces the swing low. If you exited plus 20 at 55, you would have to wait a bit, and it does happen right over here during this period, right here, before the Wednesday inflation report, which would be a really good time to exit. We do have another setup in the pound dollar over here. So we close above the 3 standard deviation. We don't get in the trade yet. You wait for rule number 2, which is a close below the 2nd standard deviation Bollinger Band. So you basically sell, let's just make it even, 128. Your emergency stop is 128.10 plus 20 pips, so 128.30. So it doesn't go anywhere near there. I really don't even think you need 20 pips. Maybe like 10 pips above the swing high is sufficient. 128, target 127.80, and boom, right here, it ends up hitting our profit target. But, maybe exiting over here, taking off half the position, or exiting at the other Bollinger, 2nd standard deviation Bollinger Band, the other side, have been a wise trade. Here's another example. Closes above the 3rd standard deviation Bollinger Band. You wait, you sell at this candle here, you sell 127.83, 127.63 is your initial target, and you definitely take your profits right here. Nice, clean trade. Also works well in dollar yen. With the dollar yen chart here, no setups over here. This is the same trade as before. Let's say you would have seen the close above the 3rd standard deviation here, here, and here. And then you go short over here, which is 149.05. Stop 149.25. This one you would have been stopped out. It would have been great. Well, let's see if you hit your profit target. 149.05, 148.85 is target. So yeah, actually you would have hit profit target. Profit target would have been hit right over here. Very quick trade. But this is the same setup. Let's see if we have other examples here. Here's another dollar yen example, really great one. We close at, this one actually closes below the 3rd standard deviation Bollinger Band. It does it again over here. We go long over here, which is at 146.46. And then it doesn't go anywhere near the stop. 20 pips easily met. This is 146. This is 146.86. But you probably would have taken some profits along the way. It also protects you from any false signals because we never closed below the 3rd standard deviation Bollinger Band there. Also, we never closed above the 3rd standard deviation Bollinger Band there. The only other time it does it is over here, where it closes at or above the 3rd standard deviation Bollinger Band. We go short here at 147.92. And, you can see that becomes a very nice move lower. This is a Forex specific trading strategy. I have not traded it on the other instruments. I invite you to put these indicators in your charts and experiment and look yourself whether or not it works or not. But for Forex, it does work quite well. And there you have it, a straightforward yet powerful 15-minute chart trading strategy that I love using to pick tops and bottoms with greater precision and accuracy. So if you found this strategy and video helpful, please like, subscribe, and hit the notifications bell so you don't miss more trading strategies and tips like the 15-minute one. Thanks for watching, and I will see you all in the next video.